Well, who gets to decide the price of a currency against any other currency? Well, to understand that, we need to have some context. The currency can fall in either of two categories. It can be a convertible currency, say for instance US dollar or Indian rupees, or it can be a non convertible currency. So, what makes them different? Well, a convertible currency is allowed to trade into the forex market, while a non convertible currency is forbidden from trading into forex market. It will come into context in a little while. So, what drives the price of a currency up or low? Well, it depends on demand and supply, very much like any other commodities that exist in the market. Let it be gold or any vegetable that you buy in the market, very much like it. If the demand of a particular currency is high and the supply is low, it's obviously going to price upward. While if the demand is low but the supply is high, it's going to drive the prices down anyways. Now, what makes demand and supply fluctuate in the market? Well, the most important factor that makes it possible is imports and exports. Say, for instance, a national company wants to buy something from an international company. For that, it needs to make some kind of foreign payments to them. For that, it needs to convert its local currency to an international currency. What will it do? It will go to the forex market and try to convert it. In the meanwhile, it increases the supply of that local currency in the market while increases the demand of US dollars. Increasing the supply will eventually fluctuate down the price of that local currency in the market, while increasing the demand obviously drives the price of US dollars up somehow. And eventually the payment is made at the expense of this fluctuation. Now, contrary to it, exports, you need to receive money. For that, the particular international company that is going to pay you will convert its local currency into your currency, and obviously, your currency demand will increase, and therefore, your currency will eventually rise against that particular currency that you're trading in. Now, where this non-convertible currency comes into play is that they do not trade into forex market. So, what might be things that it does to fluctuate its currency against any other international currency? Well, most for the most part, any non-convertible currency is the pegged currency. That is, that has some kind of fixed exchange rate against any other currency that exists in the market. Say, for instance, a Nepalese rupees is pegged with Indian rupees. So, no matter what happens, the exchange rate will remain the same. 1 Indian rupees will be equals to 1.6 Nepalese rupee. So, if it is not allowed to trade to the forex market, how will its national company actually get foreign currency for international trades? Well, in that case, government eventually, any government, regardless if they maintain a convertible currency or non-convertible currency, but most importantly for the non-convertible currency one, they maintain something called forex reserves. Like, it's a reserve of international currencies and gold. So instead of a company actually going to a forex market, it goes to the government and asks for that international currency that it has as a reserve to make international payments. And same for anything that comes inside the company, inside the country. Say, for instance, someone sends remittance within the country. The government takes US dollars as reserve and issues the local currency against that particular US dollars that has been stored as reserves. But if it was a convertible currency, this would eventually increase the demand of that local currency and increase the supply of that particular international currency, eventually driving the price up or down, whatever it might be. So, this was all about what makes a currency fluctuate against any other currency. It's our decisions to buy any international products that is from United States within residing in a foreign country that drives the price of a US dollars upward. There are many other factors that can influence the demand and supply, but that are way too technical to talk about in this video. We explored a very simple concept about it, how the finest of decisions that we make in the market every day can actually drive the prices of currency up or down. So this was all about it. Thanks for watching.